Hello everyone, my name is Ahmed Mate and my presentation today is about giving an important lesson to a family member around financing and capital budgeting for their small business. In order to start the presentation, I decided to have a small quote by Vince Lombardi. If you cannot do great things, you can do small things in a great way. Before giving the advice or diving in the lesson of today, I felt it was important to start by what it entails in starting a new business or opening your own small business. So the first step consists of sorting out the legal information. So as long as your business is not registered, doesn't have a form, you can operate, right? So it's important for the owner to know what type of business they want to open. Is it a sole proprietorship? Is it a partnership, and so on and so forth. Once they have the business registered, the next step would be to find the capital required to operate the business or to start the business. And in case the owner doesn't have the capital required, they can have access to external financing partners. And then throughout the presentation, we'll discuss about what it entails and the steps or what they need to provide in order to secure this financing, either at the startup level or down the road once they start operating. The owner also needs to develop a valid business plan if they want to have access to financing. They need to have a valid loan proposal, and we'll again throughout the discussion focus on areas where creditors and investors pay the most attention to when looking to finance or fund a business. Also, on a very important note is also to understand the strategy, the direction of the business. And then in the textbook, we have tools such as SWOT that help us understand the internal strength and weaknesses and the external opportunities and threats that a business will face. With that being said, we'll go into our introduction. We'll discuss about financial statement analysis. So what are financial statements and what are they used for by companies? So financial statements are used by businesses for internal controls and finances, for them to understand better their internal scope. They are used externally by investors, by creditors, and by stakeholders who want to provide either startup capital or to continue to provide capital that will help us continue with our operations. When we provide our financial statements to creditors and investors, they use it to determine the health of our business. So they analyze to see if it's worth it for them to invest into our business. Also, the data from the financial statements are used to evaluate the company's track record. So investors, creditors, stakeholders use it to understand how we are doing in the past, what we are doing today, and also gauge a sense of what the future will look like based on what they see today. And it's important to know that there's different type of financial statements, as we will be seeing throughout the presentation. We have at an individual level, for example, we have the individual cash flows, we have statement of financial position. At a business level, we have balance sheet, we have income statements, and so on and so forth. So throughout our presentation, we'll discuss each of those and how it is relevant to a family member who wants to start their own business. The first one is the personal cash flow statement. So you are my family owner, you want to start a business. The first thing, if you're looking for funding, is let's understand what's your cash flow, your personal cash flow. And the personal cash flow simply analyzes all your earnings, or it's also referred to as inflows. It also analyzes your expenses or outflows. So when we say inflow, we mean any income that you have had throughout the year. It can be your salary or any wages, any income from investments, any dividend income on stock investments, any income, capital gains from the sales of a business. Whatever income you've made throughout that period is your capital, or your inflow or earnings. Outflows are usually classified into two categories. So we have fixed, for example, if you have a mortgage payment, car payment, a laundry payment, and variable such as the food you eat or like your fuel every month. So it's important to understand those two. So when we go to a bank or to a financial institution to apply for credit, the creditors focus on net cash income, and the net cash income is obtained by having the difference within the income you made minus the expenses, so the total expenses, both fixed and variable, that are incurred. So when they look at these numbers, the objective is to identify if, based on your current income and inflow and outflow, if you can afford to pay more fixed expenses in the form of a loan, or if you can afford to increase your variable expenses in form of a credit card. So once you come in, you sit with the creditor, they understand how much you make, how much you spend. Based on that, they can identify how much they can give you and if it will be fixed payment or a variable payment. So once you do that, as you've got this figured out, the next step is, let's say, as a business, let's say you already have a business and you want to open a second business. The process is quite different. Here we have to focus on the income statement. So the income statement, what is it and how is it relevant and why is it relevant? Income statement shows what happened during the accounting year with regard to revenue, again, income and expenditures or expenses of the business. Companies usually generate this on a monthly basis just to be able to compare, let's say, what happened in the month of February 2020 with what was our statement in the month of February 2019. Helps them get that insight and understand how the business is doing year over year. For external purposes such as investors and creditors, the income statement is generated usually at quarterly, just for them to have a more holistic idea of what's going on in the business. The income statement is structured in such a way that in the first section you have the net sales, so you have sales minus any returns or allowances, and then the net sales is subtracted by the cost of goods sales to get you the gross profit. Once you have the gross profit, the second section consists of having the operating income, which is gross profit minus the operating expenses. At this point, tax and interest are still included. And then in the third section, we have the net income, which is operating income minus interest. Once you have that, now you deduct the taxes that were left, and then you have your net income. So that's how you calculate your income statement for a company. And again, your income statement can be used by creditors, by investors, to understand how your business is doing and as a base for providing maybe more investment, or if they are comfortable investing more in the business. Next, we are going to discuss is the statement of financial position. So that's also more at an individual level. So as an individual, when you have the statement of financial position, it shows all the items that you own, which are called your assets, and it also shows everything that you owe, which are your liabilities. And the statement of financial position is written as of date. So as of February 19, 2020, this is what you own and this is what you owe as an individual. This statement is also usually takes part of a bank application, and it's completed by a financial planner. So if you want to start a business and you're looking for funding, you go and sit with your financial planner. As of that date, they will analyze everything you own and everything you owe, and based on that, they will be able to understand the best financial strategy that will work for your business. The assets are classified also in order of liquidity, and when I mean liquidity is how fast it can be transformed into cash. So current assets, it's any assets that can be transferred into cash within 1 year, and fixed assets such as land, capital furniture that takes more than 1 year to be transformed into cash, or that cannot be amortized within one accounting year. So again, because this is for individual person, to calculate your net worth, then the formula is just the assets, so what you own minus the liabilities, what you owe, gives your net worth. And also this net worth simply means that if you sell this is how much should be worth today. If you sell all what you have and you pay every liability that you have, this is how much you'll have left for yourself as of today. On a company level, we have the equivalence, which is the balance sheet. Balance sheet also it's also a timeshot of an instant time of the list of assets, liabilities, and owner's equity. So balance sheet also has an as of date, so balance sheet as of December 31st, for example, 2019. If you've decided that your business is a sole proprietorship, the owner's equity is the business asset minus the business liability. Whatever is left over is what you can receive if you sell your business as of that day. So that's the book value. And the book value is defined as the asset on the company's books after depreciation has been determined. So that figure is most likely unrealistic figure in regard to the actual value of the business. So let's say in the book value, the price an equipment is valued at $10,000, for example, today. But in reality, it might be valued less because it has incurred depreciation. So there's always that discrepancy at this level. So again, in the balance sheet, the assets are classified in order of liquidity, also under current assets and fixed assets. So current assets can be transformed into cash within a year, and fixed assets is not used up throughout the accounting year and might take longer to be transformed into cash. And also to calculate the total asset, which is like the basics of accounting, the formula is just total assets is liability, total liability plus owner's equity gives you the total assets. So once we've understood the balance sheet, next we have the statement of cash flow. So the statement of cash flow helps us understand our working capital. So the working capital is defined as the amount of cash available for operations between the beginning of the year and the end of the current year. So the statement of cash flow is usually a comparison of two consecutive balance sheets. So we compare the balance sheet as of December 31st, 2018 and as of December 21st, 2019, and we'll compare that and the current income statement. So the current income statement as of January 1st, 2019 to December 31st, 2019. On the cash flow, the first section of the statement identifies all operating sources and uses of cash, and it is referred to as the cash flow from operating activities. The second portrays the cash generated from investing activities, and then the third section deals with cash from financing activities. Finally, you compare the net increase or decrease in cash from the previous year. After discussing the various financial statements in detail and understanding how it can help a family member that wants to start a business, how they can leverage it to have access to startup capital or capital to continue the operations, it is important now to discuss the flaws that can be associated or the problems that can be associated with these financial statements in general. So throughout the slides we've discussed about the personal cash flow, the income statement, statement of financial position, the balance sheet, and the statement of cash flow. So all of these are not perfect, and now we will tackle the problems or the heads up that can be applied in order to avoid certain costly errors. So the first issue with these financial statements is that they are written by people and are governed by tax and other laws. Hence, when it is prepared, the person preparing has to be very cautious and the person that's evaluating them has also to be cautious when evaluating them. In some cases, the fixed assets are carried on the balance sheet has an amount that does not necessarily reflect their true value. Again, as we were discussing on the balance sheet slide, some data is recorded at the book value, right? Even though depreciation is shown, some of the items that are placed at the book value may not show the actual value of the business. Various businesses also use different accounting methods. Hence, some of them use cash method, meaning that once they receive cash, the transaction is recorded, and others use accrue method, meaning that they record the transaction at the time it happens and then they accrue it when they receive the cash. So the lack of say transparency, or the lack of standardization is a big problem with these financial statements. So it means that it changes from one company to the other, hence there's no standard that investors can use, and then if you're new to the domain, you might be confused on which one to use or what is the best for the company. So it's important to understand and just use one of the methods of accounting. To continue with the problems, some businesses, as we've seen various cases such as Enron, for example, have been tempted and have altered their financial statements, and as a result, they were showing inadequate information to their investors and to the stakeholder, and then it created a big scandal. And altering the financial statements is fraudulent and can lead to prison. So it's important to always keep that integrity and always showing what you have, even though it might cause you not to have access to credit, or investors might not be tempted in investing. It's better to always give the right information to the investors. One of the biggest challenges of the financial statements is that it doesn't portray non-financial issues. As we've said, the small business that wants to be open is in a local area, hence it will have a direct impact in the environment on the population, but there's no field to disclose such impact. You can start a business, you can have positive numbers on your financial statements, but it has a negative impact on the environment. How can we record that, and how will that impact the business in the long run? The financial statements currently do not capture that. So as a result, it is important to keep that in mind. Finally, the financial statements does not capture inflation. So in case of an inflationary period, the amount reflected on the balance sheet might appear to be low, since it will be recorded with a specific time and are not adjusted with inflation. So these are some of the problems or some of the heads up that we need to keep in mind when analyzing or when dealing with financial statements as someone that wants to operate a small business. So with that being said, we've discussed the steps to starting a new business, the various financial statements, the problems that can arise, and how we can avoid those problems. We'll then jump to conclusions. So to conclude, when reading a financial statement, we should be cautious and prepare an accurate statement. As we've said, with the problems is that because man is preparing it, a human being is preparing it, they might be tempted to alter the numbers in order to have access to credit or to entice investors and so on and so forth. That's a no-no, and a business owner or an entrepreneur should stay away from these malpractices. Next, we can present more background information about the company. So let's say the numbers might not be positive, but when we're seeking for investors, it's important to give more background about the company, about the mission statement, or give us much more information, because this background can actually be the reason why you secure an investment. And finally, once starting a business, you might be tempted, or you might find all these various statements confusing, and you might want to hire an accountant. That might be a waste of budget, because nowadays we have accounting information systems that have all the packages that are simple and very intuitive, which can be purchased at a very reasonable price by the business owner to generate these various reports and that's very clear, very concise, and easy to use even for someone that doesn't have an accounting background. So having this knowledge would help you save on some startup costs, such as you wouldn't need to hire an accountant right away. So with that being said, I can gladly say that I will recommend in a few words to my family member to understand every financial statement before they venture in the business, to understand how they will secure their capital, how they will repay their capital, and clarify any questions they have with their banks, with their creditors, before taking any engagement in terms of funding, understanding the terms of the loan, understanding why they're giving the loan, and so on and so forth. So doing their due diligence when it comes to the finance of the company, because business that doesn't take care of the finances have higher chances of crumbling. So that would be my recommendation, or the most valuable lesson that I learned throughout the course is pay attention to your finances, be accurate with your finances, and then be responsible. It will all pay up at the end. So thank you for watching my presentation, and if you have any questions, please feel free to ask them below, and I will be more than happy to answer them. Thanks again for watching my presentation, and I hope it will be helpful for any entrepreneur out there that wants to apply these concepts. Have a good one, and good luck for the rest of the courses. Thank you.